The length of the moving average depends on the trader's time horizon and analytical objectives. Short moving averages, 5 to 20 periods, are best suited for short-term trends and trading. Chartists interested in medium-term trends would opt for longer moving averages that might extend 20 to 60 periods. Long-term investors will prefer moving averages with 100 or more periods. Some moving average lengths are more popular than others. The 200-day moving average is perhaps the most popular. Because of its length, this is clearly a long-term moving average. Next, the 50-day moving average is quite popular for the medium-term trend. Many chartists use the 50-day and 200-day moving averages together. Short-term, a 10-day moving average was quite popular in the past because it was easy to calculate. Moving averages are typically based on price data, and specifically closing price data. However, this indicator can be applied to other types of price data, open, high, or low volume data, or even other indicators. The example on the screen shows a chart with a 50-day SMA applied to the volume bars, and a 20-day EMA applied to the RSI indicator. Moving averages can be used to identify the trend, as well as support and resistance levels. Crossovers with price or with another moving average can provide trading signals. Chartists may also create a moving average ribbon with more than one moving average to analyze the interaction between multiple moving averages at once. The direction of the moving average conveys important information about prices, whether that average is simple or exponential. A rising moving average shows that prices are generally increasing. A falling moving average indicates that prices, on average, are falling. A rising long-term moving average reflects a long-term uptrend. A falling long-term moving average reflects a long-term downtrend. The chart on the screen shows a stock with a 150-day exponential moving average. This example shows just how well moving averages work when the trend is strong. The 150-day EMA turned down in November 2007 and again in January 2008. Notice that it took a 15% decline to reverse the direction of this moving average. These lagging indicators identify trend reversals as they occur, at best, or after they occur, at worst. The stock continued lower into March 2009 and then surged 40 to 50%. Notice that the 150-day EMA did not turn up until after this surge. Once it did, however, the stock continued higher the next 12 months. Moving averages work brilliantly in strong trends. Two moving averages can be used together to generate crossover signals. In technical analysis of the financial markets, John Murphy calls this the double crossover method. Double crossovers involve one relatively short moving average and one relatively long moving average. As with all moving averages, the general length of the moving average defines the timeframe for the system. A system using a 5-day EMA and 35-day EMA would be deemed short-term. A system using a 50-day SMA and 200-day SMA would be deemed medium-term, perhaps even long-term. A bullish crossover occurs when the shorter moving average crosses above the longer moving average. This is also known as a golden cross. A bearish crossover occurs when the shorter moving average crosses below the longer moving average. This is known as a death cross, or sometimes referred to as a dead cross. Moving average crossovers produce relatively late signals. After all, the system employs two lagging indicators. The longer the moving average periods, the greater the lag in the signals. These signals work great when a good trend takes hold. However, a moving average crossover system will produce lots of whipsaws in the absence of a strong trend. There is also a triple crossover method that involves three moving averages. Again, a signal is generated when the shortest moving average crosses the two longer moving averages. A simple triple crossover system might involve 5-day, 10-day, and 20-day moving averages. The chart on the screen shows a stock with a 10-day EMA, green dotted line, and 50-day EMA, red line. The black line is the daily close. Using a moving average crossover would have resulted in 3 whipsaws before catching a good trade. The 10-day EMA broke below the 50-day EMA in late October. But this did not last long as the 10-day moved back above in mid-November. This cross lasted longer, but the next bearish crossover in January occurred near late November price levels, resulting in another whipsaw. This bearish cross did not last long as the 10-day EMA moved back above the 50-day a few days later. After 3 bad signals, the fourth signal foreshadowed a strong move as the stock advanced over 20%. There are 2 takeaways here. First, crossovers are prone to whipsaw. A price or time filter can be applied to help prevent whipsaws. Traders might require the crossover to last 3 days before acting, or require the 10-day EMA to move below the 50-day EMA by a certain amount before acting. Second, MACD can be used to identify and quantify these crossovers. The MACD will show a line representing the difference between the 2 exponential moving averages. MACD turns positive during a golden cross and negative during a death cross. The chart on the screen shows a stock with the 50-day EMA, 200-day EMA and MACD. There were 4 moving average crossovers over a 2.5-year period. The first 3 resulted in whipsaws or bad trades. A sustained trend began with the 4th crossover as the stock advanced to the mid-20s. Once again, moving average crossovers work great when the trend is strong, but produce losses in the absence of a trend. Moving averages can also be used to generate signals with simple price crossovers. A bullish signal is generated when prices move above the moving average. A bearish signal is generated when prices move below the moving average. Price crossovers can be combined to trade within the bigger trend. The longer moving average sets the tone for the bigger trend, and the shorter moving average is used to generate the signals. One would look for bullish price crosses only when prices are already above the longer moving average. This would be trading in harmony with the bigger trend. For example, if price is above the 200-day moving average, chartists would only focus on signals when price moves above the 50-day moving average. Obviously, a move below the 50-day moving average would precede such a signal, but such bearish crosses would be ignored because the bigger trend is up. A bearish cross would simply suggest a pullback within a bigger uptrend. A cross back above the 50-day moving average would signal an upturn in prices and continuation of the bigger uptrend. The chart on the screen shows a stock with the 50-day EMA and 200-day EMA. The stock crossed and held above the 200-day moving average in August. There were dips below the 50-day EMA in early November and again in early February. Prices quickly moved back above the 50-day EMA to provide bullish signals, green arrows, in harmony with the bigger uptrend. MACD is shown in the indicator window to confirm price crosses above or below the 50-day EMA. The 1-day EMA equals the closing price. MACD is positive when the close is above the 50-day EMA and negative when the close is below the 50-day EMA. Moving averages can also act as support in an uptrend and resistance in a downtrend. A short-term uptrend might find support near the 20-day simple moving average, which is also used in Bollinger Bands. A long-term uptrend might find support near the 200-day simple moving average, which is the most popular long-term moving average. In fact, the 200-day moving average may offer support or resistance simply because it is so widely used. It is almost like a self-fulfilling prophecy. The chart on the screen shows the NY Composite with the 200-day simple moving average from mid-2004 until the end of 2008. The 200-day provided support numerous times during the advance. Once the trend reversed with a double top support break, the 200-day moving average acted as resistance around 9,500. Do not expect exact support and resistance levels from moving averages, especially longer moving averages. Markets are driven by emotion, which makes them prone to overshoots. Instead of exact levels, moving averages can be used to identify support or resistance zones. Several moving averages of different lengths can be plotted on the same chart. The moving average lines resemble a ribbon moving across the chart. In addition to analyzing individual moving average lines on the ribbon, chartists can glean information from the ribbon itself. If the lines are running in parallel, this indicates a strong trend. If the ribbon is expanding, the lines are moving further apart over time. This indicates the trend is coming to an end. If the ribbon is contracting, the lines are moving closer together or even crossing. This can indicate the start of a new trend. The advantages of using moving averages need to be weighed against the disadvantages. Moving averages are trend-following, or lagging, indicators that will always be a step behind. This is not necessarily a bad thing though. After all, the trend is your friend and it is best to trade in the direction of the trend. Moving averages ensure that a trader is in line with the current trend. Even though the trend is your friend, securities spend a great deal of time in trading ranges, which render moving averages ineffective. Once in a trend, moving averages will keep you in, but also give late signals. Don't expect to sell at the top and buy at the bottom using moving averages. As with most technical analysis tools, moving averages should not be used on their own, but in conjunction with other complementary tools. For example, chartists can use moving averages to define the overall trend and then use RSI to define overbought or oversold levels.